if Sarah passes away or breaks up with James, her assets don't get tangled in the legal battle. They stay protected in the trust for her daughter only. Protect your assets from creditors, marriage breakdown, and planning for your loved ones. I will explain how to set it up, how much it costs to set up, and how to run it. Because of all the tax benefit that trust gives people, the ATO is not particularly fond of it. Don't miss out on the most used wealth building tool in Australia. It's not a fancy investment or some crypto trick. It's something that many smart Aussies have been using and you have never been taught at school. Today, I'm going to give you this secret. It's a family trust. I will break down how this structure can help you pay less tax, protect your assets from creditors, marriage breakdown, and planning for your loved ones. All with practical examples that you can apply to your own situation. And if you are persuaded to have a family trust yourself, I will explain how to set it up, how much it costs to set up, and how to run it. Now, let's talk about Sarah. She's a single mom with a 10-year-old daughter from her previous marriage. A few years later, now she meets James. He's a decent, wonderful man, and they moved in together. Sarah is happy, but as a mom, she's thinking about the future for her daughter. Sarah owns an investment property and some savings, and she wants to make sure her daughter inherits these assets in the future. So she set up a family trust and puts the property and savings in there. Sarah, as the trustee, still legally owns and manages these assets. But all the benefit can only go to her daughter. If Sarah passes away or breaks up with James, her assets don't get tangled in the legal battle. They stay protected in the trust for her daughter only. So from the example, you can see that the trust has power to separate the legal ownership and the benefit of the asset. Normally, if you own a house, you are also the person who has the right to enjoy it. But if you put it in a trust, you can legally make someone else benefit from it. And this is protected by the law. There are a few parties involved in a trust. A trust is only a container. So you can put asset, property, portfolio in there. It's a relationship between the parties. So first one is the settlor, someone who put the asset in the trust to set it up. And the trustee is the one who manages the trust and owns the asset legally. The trustee has responsibility to manage, invest, and grow these assets for the benefit of the beneficiaries. There are a few types of trust, but most commonly used is discretionary trust. Most people also call discretionary trust is a family trust, but there is some technical behind it. Generally, people treating them the same. Discretionary trust means the trustee has power to choose who and how much they will get each year. So if your family trust has your whole family as the beneficiaries and you as the trustee, you can decide who and how much they can get, and you can change this every year. And then a very important person of a trust, an appointor. This is the person or people who has the power to hire or fire the trustee. So you have to be careful when choosing the appointor. As you can see, family trust can be very useful. That is why it is the most commonly used structure in Australia. And it is not just for the ultra-rich. Now let's start with everyone's favorite topic, tax savings. Say your trust earns $100,000. Instead of all that income get taxed in your name, you can split it across the family if it's in a trust. So $18,000 to your wife, $18,000 to your 2 adult children each, and then the rest, $46,000 to you. Your wife and kids are under the tax-free threshold, so they don't have to pay tax. And your tax on $46,000, including Medicare, is around $5,800, which is much lower if you pay tax on $100,000 yourself, which is around $22,800. And that is called income splitting. And it can significantly reduce your tax bill when done properly. However, there are a lot of integrity provisions in tax law that can apply to eliminate this benefit. And depending on the type of incomes and how you distribute it, make sure you check with your accountant to avoid these issues. Plus, trust can stream capital gains and franking credit to the best family member each year, so someone who doesn't have income in a year, for example. And the trust can also access the 50% CGT discount. Companies cannot do this. Next up, a trust can protect your assets. If you get sued or go bankrupt, assets that sit in the trust are often protected from creditors because you don't own them beneficially. In a discretionary trust, even if you are the trustee and the assets are legally in your name, you are holding them for the benefit of others, not yourself. Therefore, your creditors cannot touch them. And if you got kids, a proper family trust ensures their inheritance is well protected from marriage breakdown or from gold diggers, especially in a bad trust. Now imagine this. You've been working hard and build wealth over your lifetime. You are thinking about the next generation, but there's a problem. You don't quite trust your son. He has a history of gambling. Still, you love your grandkids and want to secure their future. With a trust, you can do exactly that. You put money in a trust and invest in something stable like ETFs and have the income used to pay for their education, and then once they reach 25, they can receive the full balance to invest, buy a home, or even start a business. Assets in the trust do not form part of your deceased estate, so any angry children cannot sue to get these assets. However, in a family breakdown, it can be tricky. If you control the trust as trustee and appointor, the court may say you have effective ownership. Even if you argue, I hold this for the beneficiary, the court may look through that if you've been distributing income primarily to yourself or your spouse. So have someone else as trustee and appointor can potentially solve this issue. Did you know that your property records and family ownership details are publicly searchable in Australia? But if a company acts as trustee and the trust owns the assets, your name doesn't show up. Privacy and asset protection aren't the same thing, but trust gives you both. Now, here's where trust really shine and provide a flexibility and control. Let's say you have 3 children, but one of them is your estranged son. You haven't spoken to him for years. You don't want to leave your asset to him at all. You want to share all of your assets to your other 2 children. If you rely solely on a will, your estranged son could challenge your deceased estate and potentially receive part of it, even against your wishes. But with a trust, you have more control. You could set up a trust and include a deed that the trustee is to hold and manage the property for you and your spouse during your lifetimes. And upon both your deaths, your 2 chosen children become the beneficiaries, absolutely entitled to the trust assets. Because those assets are owned by the trust, it's not part of your personal estate, so they are generally not subject to challenge in the same way a will is. While trust can be incredibly useful, they are not without drawback. For one, trust can attract higher land tax, especially in the state like New South Wales or Victoria, unless you jump through hoops like nominating beneficiaries or excluding foreign person in the deed. And the next issue is profit retention. Unlike companies, trusts generally need to distribute their income each year to avoid being taxed at top marginal rate. So anything remain in the trust without a beneficiaries presently entitled at the end of the year, it will be taxed at 47%, which makes it tricky if you want to retain profit to grow a business inside a trust. And another thing about trust is because of all the tax benefit that trust gives people, the ATO is not particularly fond of it. Then trusts are under increasing scrutiny, especially around income splitting and reimbursement agreement. So if you don't document things properly or you try to push the boundary, you may get into trouble. Now, after consideration, you want a family trust. To set up a family trust in Australia is quite straightforward. You will need a trust deed, which is a legal document outlining the rules of your trust. This is usually prepared by a lawyer or accountant. In there, you will decide who's the trustee. Is it yourself or a company controlled by you? You need to nominate an appointor. It's not a must, but most of the time, the deed will have an appointor. This person can hire or fire the trustee. And you can list out all the beneficiary, and you can even tell what the trustee must do every year. The setup costs typically range from $1,200 to $2,000, depending on whether you are using a corporate trustee, depending on the complexity of the trust. Once the trust is up and running, you will need to apply for a TFN or maybe an EBN, open a bank account, and lodge annual tax returns. Each year, the trustee must also decide how to distribute the income to beneficiary and document that decision through a trust distribution minute. The annual compliance cost can range between $500 to $4,000. Normally, the higher end is for a trading trust. That is all about family trust, Australia's most flexible, protective, and tax-effective entity. If you like this video, please like and subscribe. If you have a question, drop it in the comment below. I would love to hear from you. I am Hannah, the tax advisor you can trust. Thank you for watching and see you next time.